Hello, investors. Welcome to Proceemo University. Our mission is to educate folks on how to invest their hard-earned dollars intelligently and with confidence. In this episode of Proceemo University, we're going to cover market capitalization and enterprise value. We'll talk about what these are, how they are calculated, and how investors use them when making investment decisions. Let's start with the easier one, market capitalization, or market cap. Market cap is one of the most fundamental investing indicators for a publicly traded company. The calculation for market cap is incredibly simple. It's the stock price multiplied by the total outstanding shares. For example, if XYZ is trading at $10 and has 100,000 shares issued, XYZ's market cap is $1 million, $10 times 100,000 shares. Market cap is the true market value of a company because this tells us exactly how the market is pricing said company. Every time XYZ's stock gets traded, its stock price either rises or falls, and the market cap will be adjusted with the price change. If XYZ's stock price were to rise 50% in value to $15 a share, then XYZ's market cap would also rise to $1.5 million. Enterprise value, on the other hand, is a calculation used to evaluate a company's total worth using additional parameters other than just the stock price. The idea being that the market is not always right when it comes to evaluating the price of a company. There might be other intrinsic value missed in the company, or there might be diminishing value not being factored by investors. The calculation for enterprise value starts with the market cap as the starting point. Then we add in total debt, which from a finance perspective includes both long and short-term debt, and then we subtract all cash and cash equivalents. Still pretty easy. But why do we add debt and subtract cash? Shouldn't debt reduce the value of a company, and wouldn't cash increase the value of a company? Not if you are on the acquisition side of things. Imagine XYZ still has a market cap of $1 million. XYZ also has $500,000 of debt on their balance sheet and $100,000 in cash. If you were interested in buying XYZ, you would need to take on all that debt as the buyer, which needs to be factored into the buying price. Cash can be subtracted because that cash can immediately be used to reduce the debt burden if necessary. Therefore, the enterprise value of XYZ is our $1 million market cap plus $500,000 in debt minus $100,000 in cash for a total of $1.4 million. And that's a great way to think about enterprise value. If a public company were to be acquired by another public company or maybe a private equity company, enterprise value is a good place to start in terms of making an offer for said company. Private equity firms are exactly that. They are privately owned companies that typically buy other private companies or take publicly traded companies private and often restructure the company in an effort to make it more efficient or to extract as much value from the company as possible. Private equity firms are not viewed favorably because of their sometimes extreme methods of extracting value from their acquisition. This often includes deprioritizing new investments, growth opportunities, and usually includes a reduction in force. Some investors use this as an argument against enterprise value when analyzing the value of a stock. Maybe the company in question is not in a position to be acquired, and that's a fair assumption. Sometimes we see on forums or in other videos a more emotional argument against enterprise value because it's so commonly used by private equity firms, and private equity firms are quote-unquote bad. This metric must be nonsense. We would argue that thought process is nonsense. Private equity are important players when it comes to the market. They are buying public companies after all, which impacts those shareholders quite a bit. If you're evaluating a stock who has a much higher enterprise value compared to its market cap and believe they are in a prime position to be acquired by private equity, then that stock might be a great value play for your dollars. Now that we have our market cap and our enterprise value, a simple ratio to observe is the market cap over enterprise value. In the example of XYZ, our market cap is $1 million, Our enterprise value is $1.4 million. 1 over 1.4 is 0.71. We say on our Proceemo scorecard that a value of 1 would indicate a fairly priced company, because for this ratio to be 1, market cap would need to be equal to the enterprise value. Greater than 1 would mean the stock is potentially overpriced because the enterprise value is greater than the market cap, and under 1 would mean the stock is potentially underpriced because the enterprise value is greater than the market cap. This is a really simple method for analyzing value. Just like we said with the price to earnings ratio, you cannot use this one ratio in a bubble to determine your buy or sell decisions for a company. As value investors, it's best to look at as much data as you can before making that decision, and this ratio is just one small factor. And there's actually an even better ratio using enterprise value, and that is enterprise value over EBITDA, which we will be covering in a future episode of Proceemo University. Thank you for tuning into Proceemo University. Please give us a like and subscribe so you can be sure to check out new installments as they are released. Also be sure to check out our core videos to see the Proceemo stock of the week and our personal analysis of that stock. And if you really want to support the channel, please go to proceemo.com and consider signing up for our service for only $5 a month. Thank you, happy investing, go find some value.